Welcome to The Explainer. Today we are cracking open the books on BlackRock's massive third quarter. We're going to focus just on what their CFO had to say to really get a handle on the engine that's driving one of the biggest asset managers on the planet. All right, let's get right into it.
First up, let's talk about a number that is just almost hard to comprehend. BlackRock wrapped up the quarter managing a record-breaking $13.5 trillion. That is an all-time high for them. Just wow.
And look, it's not just about the massive scale, it's about the speed. The momentum here is incredible. In Q3 alone, BlackRock hit a 10% annualized organic growth rate. To put that in perspective, that's the best they've done on that key metric since back in 2021. They are absolutely flying.
So what does a quarter like that even look like? I mean, how does a company that's already managing trillions of dollars pull off that kind of growth?
Well, it looks a lot like this, a jaw-dropping $205 billion in net inflows. That is brand new money that clients decided to pour into the firm in just 90 days. Talk about a huge vote of confidence. That's a massive signal of just how strong the demand is for what they're offering.
You know that 10% figure we just talked about? In the industry, they call it organic base fee growth. And it's a really important number because it's kind of the purest measure of success. It completely ignores the ups and downs of the market and tells you one thing. How good are you at bringing in and keeping client money? And right now, the answer is very, very good.
Now here's the crucial part. This incredible growth wasn't just some fluke, you know? It wasn't one product hitting a grand slam. No, this was remarkably broad. It was like all of their growth engines were firing on all cylinders all at the same time.
And this is so interesting because you can see exactly where that money came from. Let's break down those engines. I mean, look at that. They pulled in a combined $222 billion in positive flows. The absolute powerhouse, no surprise, was their iShares ETFs. But you also see these massive contributions from their cash management business, from big institutional clients, and from the private markets, which are becoming more and more important.
And when you dig into the details, it gets even more impressive. Their famous iShares ETFs, a brand new record quarter. Those newer digital asset products, another $17 billion, they landed a single massive $30 billion pension mandate that supercharged their institutional business. And oh yeah, their cash platform officially became a $1 trillion business. That's just an incredible picture of diversified success.
Okay, so clients are pouring in money, the assets are growing, but what does that mean for the bottom line? Let's check out the financial scorecard and see how all this activity turned into actual dollars and cents.
Well, the top-line number looks fantastic. Total revenue hit $6.5 billion for the quarter. That is a huge 25% jump compared to the same time last year. And that's coming from both that organic growth we've been talking about and some recent acquisitions.
And as you can see right here, that awesome revenue growth flows right down to operating income, which was up a very healthy 23%. But you might notice that earnings per share only ticked up by 1%. The CFO pointed out that this was because those strong operating results got balanced out by a few other things, like lower non-operating income and a higher number of shares out there.
So to really get a feel for the core health of the business, we gotta talk about efficiency. And the best way to do that is to look at something called the operating margin. It basically just tells us how much profit the company is squeezing out of every single dollar in sales. And this is where the story gets really interesting. The official, as reported margin, it was actually down a little bit from last year, but the CFO was quick to point out a really key distinction. If you take out the unpredictable performance fees, the lumpy ones that you can't always count on, the core, steady, recurring part of their business actually got more profitable. Its margin went up by over 1%.
All right, so the business is firing on all cylinders, it's generating a ton of cash. So what did they do with it? Where did all that money go?
According to the CFO, they have a very simple, very consistent game plan. Priority number one is always to put money back into the business to keep that growth engine humming. And then, whatever's left, that goes right back to the shareholders. Simple as that.
And they definitely put their money where their mouth is on this one. As part of that plan to return cash to shareholders, BlackRock bought $375 million worth of its own stock in Q3 alone. And they said they plan to do at least that much again in the fourth quarter.
So to wrap up his presentation, the CFO didn't spend a lot of time looking in the rearview mirror. Instead, he looked forward, and he painted a really optimistic picture of what's coming next.
He made a really important point. They are now heading into what has historically been their absolute best quarter of the year for organic growth, and they're doing it with all this incredible strength and momentum at their back.
And then he added this really powerful personal note. He said that in his nearly 2 decades at the company, he's never seen this level of deep, meaningful conversation with clients. And what does that tell you? It suggests that the pipeline for new business is absolutely packed for the months and probably even years to come.
And that really is the big takeaway question, isn't it? BlackRock has just shown us some truly impressive, diversified growth. The challenge now is, can they keep that pace up? How will they use this incredible momentum in a global market that, as we all know, is always shifting and always full of surprises?